Hello everyone and welcome to my YouTube channel where I teach lessons of economics useful for class 11th and 12th who are in the CBSE pattern. And this is the third video of the chapter Money and Banking. You can check out my YouTube channel where in the first video I have explained about the importance of money. In the second video I explained about the basics of banking. And in this video I will explain about the money multiplier process which is related to banks. So this is part 3, the money multiplier process. So first of all, what is a money multiplier? This is basically a process where the initial amount of deposits in a bank are being multiplied into many times since they get circulated in the economy. To understand this, you can check out the video Introduction to Macroeconomics where I've explained that the faster the money circulates within the economy, the better it is. And so since macroeconomics teaches us that the faster circular flow of income provides better development of the economy, how is this actually taking place? This takes place with this practical example of money multiplier. The faster money changes hands from person to person and sector to sector, it keeps getting multiplied with the help of banks. And this is also called as credit creation process. So how does this actually happen and how does money actually get multiplied? We will try to understand in this video. So first of all, to understand the money multiplier process, we have to revise two topics. The first topic which we have to revise is the circular flow of income. For that, you can check out my YouTube channel in the video National Income, where I've explained about the circular flow of income, where money changes hands from sector to sector. The second topic we have to revise is the reserve deposit ratio, also called as the legal reserve ratio, and it is there in the second video of Money and Banking. Please check out my channel for that. Now, after revising those two topics, you can come back, and here there are two assumptions to understand this concept. The first assumption is that imagine that all the transactions are bank transactions and not cash transactions in this example. And the second assumption is we have to imagine that in this economy only one bank exists. This is to make it very, very easy to understand the money multiplier process because this is slightly complicated. So we'll begin with the example. Imagine you have 1,000 rupees and you have deposited it in your bank. The bank is supposed to strictly follow a reserve deposit ratio of 20%, which means 20% of 1,000 rupees has to be kept as reserve and the rest 80% can be given out as loans. Which means when the bank receives 1,000 rupees from us, 200 rupees, that is 20%, is kept as reserve and the remaining 800 rupees, that is 80%, will be given out as bank loan. Now imagine the person to whom the loan has been given as 800 rupees, he or she will not keep this money in his or her pocket. Loans are usually taken for spending or investment, so that person will take that 800 rupees loan and spend it on the products of a shopkeeper. And that shopkeeper, once he or she receives that 800 rupees, will put it in the same bank. Imagine the assumption of one bank. And now, once again, this has come as a deposit. These 800 rupees have come back into that bank as a deposit. And once again, the bank will use the same technique. 20% will be kept as reserve and the remaining 80% will be given out as loans. Which means the 20% of 800, that is 160 rupees, will be kept as reserves and the remaining 640 rupees will be given out as loan to someone else. Moving further, imagine this process continues over and over again. Somehow this will have to eventually stop. If you can see the table on the right, initial deposit was 1,000, 800 was given as loan. Somebody else took that loan, spent it. That person deposited 800. It became 640 as loans while the remaining 160 as reserves. And this process continues. So the money multiplier process helps us to explain when will this process stop. According to them, this process will go on and on until the initial level of the deposit will be multiplied by the number of times of reserve deposit ratio. Which means in simple terms, the initial deposit, that is 1,000 rupees, will be multiplied until the total deposits amount to 1 by RDR times. So we'll try to solve this formula. In this example, 1 by RDR times is 20%, or in mathematical equation it is 1 by 20 into 100. So when we do 1 by 20 into 100, it comes 5 times, which means that this process of money multiplier will go on and on until the deposits will become 1000 into 5, or 5 times the deposits, that is 5000 rupees. Which means the total deposits received by the bank will be 5000 rupees here, as it is shown here in the table. The total amount of loan given will amount to rupees 4000, and the reserves kept by bank will be the 1000 rupees. So this is basically how money is being multiplied by banks. They keep on giving loans, and they keep on taking deposits, and they keep on taking reserves as well. So as the deposits are repeated again and again and again, it will be ending at a point where the total deposits will be equal to 1 by RDR times, and then the remaining will be the loans given and the reserve amount. So if you do not believe me, you can keep on doing the process of this table, where 262.14 will be once again kept as deposits, 209.71 is the loan given, 52.43 is the reserves. And if you keep on doing this particular process of giving loans and taking deposits, you will reach this amount, total amount of 5000 total deposit received by the bank, 4000 total loans given by the bank, and 1000 the total reserves taken by the bank. This is called as the money multiplier process. So once again, a recap of the entire process. From the above example, we come to know that the initial level of deposits will continue to multiply in an economy, since they are changing hands from one sector and person to person. If it keeps changing hands from sector to sector, the money will keep on multiplying, and the process will continue until the total amount of deposits in that bank become 1 by RDR times of the initial deposit. So using this formula, I will give you two mathematical problems, and let's see who is faster. So the first problem is, try to find out the total amount of deposits if the initial deposit was rupees 100 and the RDR, or the reserve deposit ratio, was 5%. The second problem is, also try to find out RDR if the total deposits in a bank were 1 lakh rupees and the total loans given out were 78,500. So the clock is on, it's a race between you and me. So let's solve the first problem. So in the first problem, try to find out the total amounts of deposits if the initial deposit was rupees 100 and the RDR was 5%. So now the initial deposits is 100 and the RDR is 5%. The formula is 1 by RDR times. The initial deposits will be multiplied until the total deposits are 1 by RDR times. Here 1 by RDR is 1 by 5 into 100, that is 20 times. So which means the money multiply process will be continued until the initial deposits 100 rupees becomes 20 times, that is 100 into 20, that is 2000 rupees. So this is going to be the total deposits in this particular example. In the next mathematical problem, here's it is there, also try to find out the RDR if total deposits in a bank were 1 lakh and the total loans given out were 78,500. So once again, I'm writing this down. The total deposits are 1 lakh rupees. The total loans given out were 78,500 rupees. So the reserves of the bank will be 1 lakh minus 78,500. So 1 lakh minus 78,500 is 21,500. And this is the reserve kept. So 1 lakh were the total deposits received by the bank. 78,500 out of this was given as loan. So the remaining 21,500 is kept with the bank as reserve. So by doing cross multiplication, what will we do is 21,500 divided by 1 lakh into 100, we will get the percentage of reserve deposit ratio, that is 21.5%. So if out of 1 lakh, 21,500 is kept as reserves, out of 100, how much is kept as reserve? And by doing the cross multiplication, we will get the answer 21.5%. So this is the reserve deposit ratio, which is used to keep reserves, so the remaining amount will be given out as loan. With this, we come to the end of this video. You can check out my YouTube channel, where in the first video I explained about the importance of money. In the second video, I explained about the basics of banking, and in this video, in a very short and concise manner, I have explained about the money multiplier process. Stay tuned in my channel for the next video, where I'll explain about the central bank. Thank you so much. Stay educated and stay safe.